you compare this to where we were in 2007, debt is not that much different. It's been pretty flat, whereas the amount of household equity is much, much higher. The credit availability index for March fell 16% to the lowest level since 2015. The real cutback was in jumbo credit, which was much, much tighter. Non-banks play a very important part of the market. The non-bank originators have a much wider credit box than their bank counterparts, especially for Ginnie Mae. Non-banks are also more tolerant in the debt-to-income dimension as well. There's going to be much more credit tightening in the months ahead. There's been a severe pullback in terms of home purchase activity. What could go wrong with refinancings? That's pretty straightforward. But even here, we're not prepared for the virus. First, title searches can't be completed in areas that don't have computer searchable records. Verification of employment and confirmation of continuity of income is very, very difficult in this environment. Traditional appraisals can't be completed, and many states don't accept e-notarizations.
I thought maybe to kind of walk you through understanding kind of the payments the borrower makes and where the money ends up going. Any principal that comes in, they're not obligated to pay that for another month. Fannie Mae or Ginnie Mae looks at that principal interest account at the bank where they've been depositing the funds from the consumer, and they say, is there enough money in there to cover money that's owed? And if there's not enough money, the servicer has to advance the difference. As much as 25% of the loans could be forbearance, and under the CARES Act, the federal law that required forbearance, it could at least be 6 months, it could be as long as a year. If we have 25% forbearance for 6 months, almost $3 billion in servicing fees will not be collected. How do we deal with the servicing fee, the escrow deposits, and the guarantee fees? Today, the refinance and unscheduled principal balance is really bailing out the servicers when it comes to their monthly P&I accounts.
1/3 of the households are renters, and in fact are hardest hit in this pandemic for a variety of reasons. Lowering people's payments on their mortgage is the most effective way of keeping people in the house. Making sure we avoid foreclosures are very important. The forbearance plan is a way of doing that. We really need to provide more certainty as to who's going to pay when. Obviously, one way of helping people who are unemployed is just extending unemployment insurance, and we've done that at least through July. The CARES Act did a small amount of eviction protection if you have a federal mortgage. There's been a lot of talk now in basically passing legislation that will provide additional assistance to renters. Do you try to provide the money directly in the form of rent vouchers, for example, to the tenants, or do you try to pass the money on to the owners of the properties when people aren't being able to pay rent? And I really worry that the mortgage market that we've set up are not going to loosen very quickly, and we will see very tight credit, a real break on the economy coming back quickly. Something that policymakers will really need to focus on. How do we get credit started again?